Well, Ronan Barratt, is coming to us with two stocks he likes for 2023. But welcome to the program. Nice to have you here.
Nice to be here.
I thought maybe you could just set the scene as far as your outlook for small caps in 2023, because so far this year, so good.
That's right. Yeah, we've seen a bit of life breathe into the markets as we kick off 2023. We think that's partially due to offshore factors, the early signs of inflation beginning to ease in the US. The reopening of China's economy as well has helped too. But notwithstanding that positive start to the year that we've seen from the indexes, our base case would be that markets stay pretty volatile over the coming quarters. So for that reason, we think it's going to remain a stock pickers market. You're going to need to be selective, and that's why we've brought along two of the MA Financial preferred picks to discuss today. That's Aspen Group and RPM Global.
Okay, so I've sort of foreshadowed this. Aspen Group, I know you do deep dives into companies, your research, analyst, so this is exciting for all of us. Just give us a bit of a background as to what it is, and I suppose as well, why you like it now.
Of course, yeah. So look, Aspen Group's a real estate business. It has a market cap of around $350 million. Aspen owns and operates over 4,000 dwellings or sites across Australia, split across three key subsectors: residential, retirement, and holiday parks. So for the residential segment, think low-cost apartment buildings, student accommodation, townhousing. In the retirement space, you're looking at land lease communities. So these are where the tenant is leasing the land for circa $180 a week. And the last segment there is holiday parks, which are kind of your classic coastal holiday parks. Why we like the stock is that essentially it's a play on affordable housing. That's an appealing thematic at the moment because we know we're in a housing affordability crisis. The government has acknowledged that. And Aspen's out there delivering good quality, affordable accommodation into the market to meet that need in the community. But also through strong management, they're able to do that with high returns on capital and good unit economics in their development business. So there's an attractive story there for the shareholder too.
Yeah, so you've got to trust management to execute and to be able to allocate capital properly. But like, what's the earnings makeup? Is it rent or is it sales or?
Yeah, sure. So about 80% of Aspen's earnings come from the rents, which they essentially passively collect from the properties that they own. But about 20% of the earnings come from the development side of the business as well. So there are a couple of important things to point out about the operations. One is that the assets do need to be actively managed, and so the co-CEOs are very experienced industry professionals. They've got a long track record in successfully managing assets such as these. They own 8% of the business themselves, so they're well aligned with shareholders and focused on delivering good returns. But the other important factor is that because the rents are set at such affordable levels, typically less than $400 a week, that creates, essentially Aspen's tenants can pretty comfortably afford these rents out of, say, the age pension or quite a low income. So what that creates for Aspen is a very defensive earnings stream. It's one that's quite insulated from what's happening elsewhere in the economy, or particularly in what's happening in more expensive areas of the residential market, which are more vulnerable to a downturn.
Okay, so does Aspen Group have to continue to buy, develop, and then rent? Like, where would they look to expand?
Yeah, so look, perhaps it's good to talk through an example of what they've done to date. So, a classic example is their Perth apartments project. So in 2021, Aspen purchased around 500 existing apartments in Perth for $55 million. These were, buildings that were well located in Perth, but needed significant refurbishment to get the occupancy and the rents up to where they need to be. The key to the transaction was kind of twofold. One is that Aspen bought these properties at well below replacement cost, so they paid around $100,000 per apartment. It would have cost more than double to build them again. The second is that they timed the transaction very well. So the Perth market was essentially coming out of a 6 or 7 year bear market after the previous mining boom, and that's when they acquired them. So essentially the all-in cost for Aspen for this project, including the refurbishment, will be around $90 million. When the project completes in around 12 months' time, we think the end value of that project will be around $150 million once all the apartments are leased up. And so in circa 2 years, they've kind of turned $90 million into $150 million. And you're also going to get circa $6 million of net rent, almost in an annuity stream thereafter, flowing into Aspen Group. So yeah, look, the exciting thing for Aspen is that their balance sheet can take on more projects such as this. And so, with rising interest rates potentially triggering some distress in the resi market in calendar 23, that could present some opportunities for them to make acquisitions.
Okay, so if it's a stock picker's market, is Aspen well priced right now? I mean, is now the time to buy? I know that we're talking stocks for 2023, or could you wait? Like, what would you be waiting for? I don't know.
Yeah, so no, we think it is the time to buy it. I mean, we think Aspen will be growing its earnings by around nearly 10% a year over the next couple of years on a CAGR basis. We think another key part of the story is the net asset value. So the net asset value last stated was $1.78 per share. We think that net asset value is going to go well through $2 a share over the next 12 or 18 months. The stock's been trading around $1.80, $1.85 on a price to earnings multiple of less than 18 times. We just think that's too cheap for a business that's got asset backing, a defensive nature, and a long runway for growth. So yeah, look, we're looking for the stock to trade, through $2 over the next 12 or 18 months as that net asset value increase comes through. Part of what's going to unlock that is that Perth Apartments project that I referred to before. In addition, you're also receiving a 4% dividend yield on this stock on the way through.
Interesting, really interesting story. Okay, the next stock that's on your list is RPM Global. Now, I have heard of RPM Global. Thank you very much. RUL is the ticker code, but why is that a stock for 2023?
Yeah, so as you know, RPM is a 400 mil market cap provider of high-end mining software. The group's also got a mining advisory group, which complements the software offering. Look, RPM's a really well-established company. They sell mission-critical software to a wide range of clients, including tier 1 miners like BHP, Rio, and Glencore. The mining sector is currently undergoing a digital transformation at the moment. So many of these tier 1 miners, they're swapping out a lot of their old legacy technology. A lot of it was developed in-house. It's just not fit for purpose anymore. So there's a big opportunity for groups such as RPM to come into the market and deliver specialist software solutions that meet those miners' needs right across each phase of the mining lifecycle. What attracts us to the stock right now is, it's a profitable software company. It's got margins expanding quickly. The second is that it's got good organic growth. It's got good sales momentum in the business. So they're growing software sales by at least 15% at low rates of churn. Next, it's got a good balance sheet. There's over $30 million of net cash there, which they're using to buy back stock. And lastly, there's been some interesting M&A activity in the sector recently with a couple of peers taken out at some large valuations. Okay,
but when we talk software, why can't somebody else just spin up their own sort of version of what RPM Global's doing?
Yeah, so there are competitors there, but RPM's got over 40 different software modules right across the mining lifecycle. But the key flagship product, which is recognised globally as an industry-leading solution, is their asset management tool known as AMT. So this solution is essentially used to track the maintenance cost of all assets within a mine site, and then accurately forecast what those costs will be versus budget right through to the end of the mine's life. What's interesting is that up to 50% of the total operating costs in a mine site are the maintenance costs. And so, some of their customers are spending over $10 million a year on each individual site on maintenance costs each year. So for them, spending a couple of $100,000 on what is an industry-leading solution, if it's going to reduce those maintenance costs, it can be well worth it.
And it's sticky once they buy it.
Absolutely.
Yeah, because they embed it in within all their operations.
That's right, it's mission critical.
Okay. Would RPM Global, given it's an Aussie company, global blue chip clients, would it ever be taken out, bought by somebody else, or could it be the acquirer if there was to be consolidation in the space?
Yeah, so look, they have had a history themselves of making some acquisitions in the space. Given it's a well-established company, it's got very good distribution and reach. So they have acquired some smaller software companies, plugged them into their platform, and then leveraged their existing client base to cross-sell that software. But equally, as I mentioned earlier, there's been some interesting M&A in the space more broadly. So in calendar year 22, we saw two interesting transactions. One was Deswick, which is a peer of RPM's, was acquired by Sandvik, an OEM, for $750 million at about 15 times software sales. The other key transaction that took place was Micromine, which was acquired by Aspen Technologies, not related to Aspen Group that we spoke about earlier. That was acquired for $900 million. So these were similar size, similar natured businesses to RPM. And RPM, by comparison, is trading at less than a $400 million market cap and around 6 times its software sales. So it could be appealing to an original equipment manufacturer like a Sandvik, a Caterpillar. It could also be appealing to other larger software companies. So yeah, it's interesting because RPM doesn't necessarily screen obviously cheap next to some other ASX software companies.
Yeah.
But within this vertical of mining software, you've seen that transactional evidence to help support the valuation.
Well, and that's what I was going to say. So yes, it's been beaten down because all of tech has been beaten down. But when it comes to, are you willing, basically what you're saying is you're willing to play for a profitable tech company because profitability is so rare, in that area.
Yeah, and look, it's interesting because over the last 5 or 10 years, RPM has invested heavily into its software platform. It's changed its sales mix towards that higher margin, more profitable software sales, and away from some of the lower margin advisory and services sales. And they're really hitting a key inflection point on that this year. So their guidance is for EBITDA to grow from around $4.5 million last year to $14 million in FY23. And that'll take EBITDA margins from circa 5% last year to around 14% this year. So what that's telling you is that the incremental software growth in this business is really being allowed to drop through to the bottom line, without that commensurate growth in the cost base that you see in other software stocks.
Well, I love that. Thank you. I now know about Aspen and RPM Global, 2 stocks for 2023 in the small end of the market. Ronan, thanks for coming in.
Thanks for having me.
We do hope you return from MA Financial. All right, let's get to our small cap in focus, Frontier Energy. It's a renewable energy company. It's developing the Bristol Springs green hydrogen project. So that's located just south of Perth. It is actually putting it out there in terms of targets and near-term objectives. So let's find out what those are with Sam Lee Mohan. He is joining us from Frontier Energy. Welcome. Nice to have you here. So you're already sort of going green if you're in the hydrogen space. So what is this exactly that you've put forth in terms of what you're laying on the table for the market?
Wonderful to be here, Nadine. Thanks for having me. So in terms of Frontier Energy's foundation, Bristol Springs solar hydrogen project is essentially a 114 megawatt solar farm that's directly coupled with a hydrogen production plant that will produce around 4.4 million kilograms of green hydrogen per year.
Okay, and when we talk green hydrogen, everybody's always very concerned about the timeline. It's a long ways away. It's going to take so much further investment to make it happen. Talk to us about your future focus, your future view for hydrogen, green hydrogen, and when it will become commercially available and commercially used more widely.
Yeah, absolutely. The market is definitely in its infancy. But one of the quite unique competitive advantages that our Bristol Springs project has is its closeness to critical infrastructure, particularly the Dampier to Bunbury natural gas pipeline, as well as the Pamelia pipeline that's run by the Australian Gas Infrastructure Trust. And so these quite unique advantages, it actually is potentially a natural home for our hydrogen, as the hydrogen can be injected into the pipeline. But also the unique advantages is the connection onto the Southwest Interconnected Electricity System, which we have a connection onto. So power generation is actually another opportunity presented by our project. And we are just 50 kilometers away from the port of Bunbury, which opens up export markets, etc. So in essence, with all of these competitive advantages and the low cost at what we can produce hydrogen, we actually are aiming to have first hydrogen by the end of 2025. All things being equal, obviously, with securing offtake, which we are actively in the process of doing.
Yeah, that's interesting. So offtake will come pre-construction, pre-production, obviously. Where does the interest come from for those supplies?
Yeah, look, in terms of that supply, I think offtake comes from, you have to look across the supply chain, across the entire gas value chain. Now, here in Western Australia, we have a domestic gas obligation policy on LNG exporters. And given that we are right next door to the Dampier to Bunbury natural gas pipeline, and downstream of that pipeline, you've got major users like Alcoa, South 32, the Kemerton Strategic Industrial Estate. So with LNG exporters trying to expose and really capitalize on the volatile gas export market, using hydrogen as a domestic gas offset actually will provide value not just to LNG exporters, but actually local consumers, as well as the WA government, to strengthen the economy. So we actually see a deal being done with LNG exporters as well as domestic users on the gas pipelines.
Yeah, okay, interesting. Now, one thing that comes to my mind is costs, construction costs, running costs in an inflationary environment, and then balance sheet. So what is the plan at Frontier Energy to bring this to fruition once all the checks and balances are made?
Yeah, I think fundamental to the offtake is really targeting super majors, with A-, BBB+ balance sheets that will sort of underwrite the foundation project. Now, in terms of construction and supply chain, etc., there's definitely a lot of pressure on the supply chain. But the unique advantages of Frontier's project is it has freehold land, it has permits already in place, planning approvals in place, it has engineering done to a level of where we are comfortable to secure offtake. And what these advantages are giving us is preferential treatment in terms of that supply of equipment. So we've just undertaken a pre-FEED study, and as part of the pre-FEED, we've engaged the market for equipment, and that's returned quite favorable. Now, in terms of cost, our unique advantages has really positioned us to produce what, in my opinion, is the lowest cost hydrogen globally at $2.83 a kilogram. So that cost of production is really predicated on the unique aspects of Frontier's Bristol Springs project.
Great. Look, I wish we had more time to talk, but I have a feeling we'll have the opportunity in the future because, as you say, there's a lot of work to be done. But thanks for keeping us up to date. Really appreciate it.
Thank you for having me.
Yeah, that was a good program. Thank you for joining us on the Small Caps. Don't go anywhere, though, because if you're into Web3, if you're into the future of finance, we've got something coming up for you next.